Hi, this is Journey from the UIS Learning Hub, and this is video 1 on financial accounting or accounting 211. The goal of these videos is to supplement your learning and is in no way meant to be a replacement for the actual materials provided by your professor. These videos should serve mainly to reinforce the needed topics to succeed in this course, as well as make this information widely accessible and available. In this video, we will be covering some of the introductory concepts for financial accounting that will be relevant throughout the rest of this course. First, we'll briefly overview the purpose of financial accounting and then go over the 4 different types of financial statements, and then go over the accounting equation and preview how to analyze transactions by using the accounting equation. The purpose of financial accounting, simply put, is to give information to people who are outside of the company. Usually you'll see on the news that publicly traded companies like Apple or Microsoft provide quarterly reports to the public and shareholders. And these reports include metrics like their net income, their revenue, their assets, their liabilities, and the overall financial state of the company. With that purpose in mind, there are 4 different types of financial statements that provide outsiders with important information that you'll need to familiarize yourself with in this class. This being the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows, which we'll examine further here in a second. First, let's start with the income statement. The income statement is basically just a summary of revenues and expenses for a specific time period. Usually it's in quarters, but it could also be within a month or a year. The income statement is categorized by revenue and expenses. To define the 2 sections, revenue is basically what is earned or gained when a company sells a good or performs a service. And the specific revenue can be defined within certain accounts that you will need to know when analyzing transactions, doing journal entries, or T accounts. If what I just said made no sense to you, don't worry, you'll begin to understand as you continue with the course. When a company earns revenue by selling goods or merchandise, this is known as sales. When a company earns revenue by performing a service, this is known as fees earned. And there are also other accounts such as rent revenue or interest revenue, which are pretty self-explanatory. Continuing with expenses, expenses are just the costs that are incurred when you generate revenue. If you bought items to sell, that would fall into the expense category of cost of goods sold. If you have to pay your hourly workers, it falls in the wage expense category. When you have to pay your salaried workers, it's a salaries expense. And when you buy utilities for the company, it falls under utilities expense. Second, let's look at the balance sheet. The balance sheet is a little easier to think about. It's just the list of assets, liabilities, and owner's equity of a company on a specific day. In this course, we think of assets as things like cash, plant, property, land, buildings, and equipment. So all of these encompass the definition that it's a resource that's owned by a company that has some sort of value. Much later in this course, this will also include intangible assets, this being things like patents and copyright. The liabilities, on the other hand, are the negatives of a company. They're what you owe to others or the debts of the business. So say for example I own a lemonade stand, and I don't have any money for cups, so I go across the street and ask my neighbor for cups, promising him that I'll pay him back a week from now. I now have an asset, as I gained equipment in the form of cups, but I now also have a liability because now I am in debt to my neighbor. And having a standing debt where you owe money to someone would fall under the account called accounts payable, being a liability. Accounts payable can also be more specific. For example, if you owe money to an employee because you're late on paying them, that would be wages payable. And if you owe money on interest payments, that would be interest payable. Next is a statement of owner's equity, which is a summary within a certain time period of changes in the owner's equity or the owner's claim on assets after all liabilities and debts have been paid. The 2 accounts that will be especially relevant in this course are the owner's capital account and the owner's drawing account. When the owner of a company is adding money into his business, this is the owner's capital account. When the owner of a company withdraws money from his company, this is the owner's drawing account. The statement of owner's equity is unique in the sense that it'll show the relationship to other accounts. For example, if I decide to invest $500 into my lemonade stand, because I'm gaining $500 worth of assets, it increases owner's equity because it's my claim on the assets after the liabilities and debt is paid off. The last financial statement is the statement of cash flows. Although this is also a very important sheet, this is most likely the financial statement that will be utilized the least in Accounting 211. But that of course depends on the time and the professor. The statement of cash flows is a summary of the cash receipts and the cash payments for a specific period of time. It is usually organized under operating activities, financing activities, and investing activities. To put it more simply, this shows the cash flow, whether negative or positive, from operating activities like the cash from customers and the cash paid to run the operation, as well as the cash coming in or out from the other financing or investing activities. Potentially the most important takeaway from this video is the accounting equation. You being able to do well in financial accounting depends on you understanding this equation. Assets equals liabilities plus owner's equity. Take a special note of the equal sign. This means that the equation must balance. So if I increase assets by 5, the other side of the equation, liabilities or owner's equity, must also increase by 5 so the equation can balance out. For example, let's say I sell a cup of lemonade for $5 in cash. As part of revenue, this increases my assets by $5. So the other side of the equation needs to increase by $5 as well. Well, we know from the definition of owner's equity, being the claim on assets after liabilities are paid off, that an increase in assets means an increase in owner's equity, meaning the equation balances out because owner's equity increases by 5 along with the $5 increase with assets. Those are some of the foundational concepts that are necessary to know in this course, but we can only apply the logic of the accounting equation by looking at transactions and seeing how it affects the accounting equation. Take a few minutes to figure out how these transactions can affect the accounting equation. So hopefully you've paused the video and figured out the 3 questions. Let's start with number 1. So Brenda's bottling business gets $5,000 in cash for services provided. What's happening here? So in this transaction, we're getting cash, which is categorized as an asset. So because we are getting cash, an asset increases, which means either liabilities or owner's equity has to increase. And there's no liability here because we don't owe anyone anything. And like we said earlier, since we're increasing our assets and through the revenue, our owner's equity or what we own also increases. So the equation balances out as the assets increase and owner's equity increases within the accounting equation. Next, let's look at number 2. So Brenda's business decides to purchase $5,000 of equipment on account. What's happening here? So if you're new to this course, you might have noticed the words on account. What buying on account means essentially is buying with credit or with a promise to pay back later. So in this problem, we are gaining new equipment, but we now owe money to the store we bought our equipment from. We still have the equipment in this scenario, which falls under the category of an asset, meaning assets increase here by $5,000. But remember, we haven't paid the money yet, and we owe it to a store, meaning there's a liability involved, which means liabilities also increase by $5,000 in the form of accounts payable. In the last example, Brenda pays back the money she owed from the previous problem. So what happens here? So since Brenda is paying back in cash, it's an asset, meaning assets are decreasing. So to balance the equation, we decrease the assets because we lost cash in paying them back. And we also decrease the accounts payable liability since we are settling the debt or liability that we owe. Thank you for watching. Hopefully this was helpful, and videos on financial accounting will be continued in the next video.